Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Exxon Mobil.
If you find our talks useful, please consider subscribe, like, and comment underneath. Okay, so let's unpack this. We are looking at a beast of a company today.
We really are.
I feel like everyone knows the name, everyone has seen the gas stations, but what is happening with the stock right now is, well, frankly, it's pretty wild.
It is. And if you think you know this company just because you fill up your car at their pumps, you might be missing the real story playing out on Wall Street.
Right.
If you look at where ExxonMobil sits right now, and we're recording this in mid-February 2026, the stock is trading at $155.56.
Which is all-time high territory.
Exactly.
Yeah.
But the price itself isn't the headline, it's the velocity of the move.
The momentum, that's the story here. I was looking at the charts before we started, and it's up over 5% in just the last week.
Yeah.
But you zoom out just a tiny bit to the last month, it's up 25.4%.
A massive move for a company this size.
It's huge. That's not a penny stock popping on a rumor. That is a mega cap giant moving like some volatile tech stock.
It's unusual. And to give that some context, year to date, Exxon is outpacing its entire sector with gains sitting roughly between 19 and 24%. It's leading the pack.
So what's happening?
What's fascinating here is the broader market context. We aren't just seeing an oil boom. We are seeing a rotation.
A rotation. You mean money moving from one sector to another?
Precisely. The market sentiment right now is screaming, cash is king.
Okay.
Investors are getting a little wary of that speculative growth companies that promise profits, 10 years from now.
The jam tomorrow stocks.
Exactly. They're flocking back to asset-heavy names, companies that make real things and, crucially, generate real cash today. It's a flight to quality, and ExxonMobil is kind of the captain of that ship right now.
So the big question then, and I think this is what everyone listening wants to know, is this just the stock riding a temporary wave of oil prices? Or is there something, fundamental changing under the hood?
That's the key question.
Because a 25% jump in a month, that needs a solid justification. You can't just ride sentiment to a $250 billion value increase.
It absolutely needs it. And the answer, I think, lies in the fundamentals. This isn't just speculation.
Okay.
If we look at the earnings machine itself, the numbers from Q4 2025 tell a very compelling story. They posted earnings of $6.5 billion.
$6.5 billion in one quarter.
About $1.53 per share.
Not bad work if you can get it.
It's impressive.
Yeah.
But here's where it gets really interesting. It's not just about what they earned. It's about what they did with that cash.
Right.
The wealth building aspect here is just staggering. In 2025 alone, ExxonMobil supported $37.2 billion in shareholder distributions.
Wait, $37 billion?
$37.2 billion.
That is. That's the GDP of a small country just handed back to shareholders in 12 months.
It is. And that's why that cash is king narrative fits so perfectly.
Mm-hmm.
Investors want to see returns now, not later. They've also laid out a plan for $20 billion in share repurchases through 2026.
Okay, let's pause on the buybacks for a second. For anyone listening who hears share repurchases and their eyes glaze over, why is this such a big deal for the stock price?
It's a great question. Think of it like a pizza. The company is the whole pizza.
Okay.
If you cut it into 8 slices, each slice is worth a certain amount. Now, if the company buys back 2 of those slices and just gets rid of them, you now have a pizza cut into 6 slices.
So each slice is bigger.
Each remaining slice is bigger. It represents a larger ownership stake in the company. So even if the company's total profit stays the same, your profit per share goes up.
So they are aggressively shrinking the share count, which drives up the value of the shares I'm holding in my account.
Exactly. But the real magic, and the part that often gets overlooked, is how they have the cash to do this.
Yeah. Right, because you can't just print money. You have to earn it or save it. And usually these big old companies are bloated. They have layers of management, legacy costs.
That was the old Exxon. Since 2019, they have achieved $15.1 billion in cumulative structural cost savings.
Structural savings. So that's not just deferring maintenance or firing a few consultants?
No, this is fundamental. They have changed how they operate. Consolidated supply chains, centralized decision-making, using tech to lower the cost of every single barrel they produce.
And $15 billion, that's a huge number.
It is. And to put that into perspective, They have achieved more cost savings than all other integrated oil companies combined.
Wow. Okay, say that again.
They have saved more money through efficiency than all of their competitors put together.
Combined.
Combined. That's the scale of the efficiency engine we're talking about.
Okay, that explains the cash is king rotation. They're leaner, they're saving more, and they're handing that cash back at a record pace. But here's the devil's advocate question. You can't save your way to growth forever, can you?
No, you can't.
Eventually, you run out of fat to cut. You have to pump more oil or sell more product to actually grow.
You hit the nail on the head. Cost cutting protects the downside, but you need a growth engine for the upside. And Exxon has that too, which is the other half of this rally.
And that is?
They just hit their highest annual upstream production in over 40 years.
40 years. That's going back to the 80s, the era of Dallas and shoulder pads?
It is. And it's not just about pumping more. It's about pumping better. They call these advantaged projects. The star of the show right now is Guyana.
I've heard about Guyana. That's been a massive discovery for them. Everyone in the industry is talking about it.
It's a game changer because of the economics. It's low-cost oil.
Mm-hmm.
And the Yellowtail project there started 4 months ahead of schedule.
Is that rare?
In this industry,
Yeah.
it's almost unheard of. Major offshore projects are notorious for dragging on, hitting technical snags, going way over budget.
Right.
Finishing 4 months early is a massive testament to their execution.
And that means cash flow starts 4 months earlier than planned.
Exactly. Then you have Brazil with the Bacalhau field, another key driver. But if we look forward to 2030, the picture gets even clearer. They're not just relying on old legacy wells.
Okay.
By 2030, 65% of their upstream volumes will come from these new high-margin assets, the Permian Basin, LNG, and Guyana.
So they are essentially upgrading their entire portfolio, replacing older, more expensive barrels with newer, cheaper, higher margin barrels.
That's the strategy in a nutshell. It's a portfolio upgrade. And because of that shift in quality, they are projecting an average annual earnings growth of 13% through 2030.
13% annual growth for a company of this size is, well, it's significant. You usually look at these giants as slow-moving yield plays, maybe 2 or 3% growth if you're lucky.
You don't expect double-digit growth.
No.
That's the misconception. And it's why the stock is re-rating. Investors are realizing this isn't a stagnant utility, it's a growth compounder. But there is another layer to this onion, and it's what I like to call the moat.
The moat. Love a good moat. This is what keeps the competition out.
And protects their margins. We talked about digging the oil up, that's upstream.
Yeah.
But we also need to talk about what they do with it downstream. They also hit a record for refinery throughput.
Right.
But the strategic shift is what's fascinating. They are moving away from just making basic fuels and towards product solutions.
Product solution sounds a bit like corporate speak. What does that actually mean for the business?
It means taking a barrel of crude and squeezing the absolute maximum value out of it. It's all about molecular management. Let me give you an example. The Singapore Resid upgrade.
Okay, unpack that for us.
So historically, when you refine oil, you end up with some leftover sludge at the bottom, heavy fuel oil. It's cheap, dirty, low margin.
Stuff nobody wants.
The stuff nobody wants. The Singapore project upgrades that low-value bottom-of-the-barrel stuff into high-value products like lubricants or cleaner fuels. They are literally turning trash into treasure.
So they take the cheap stuff and turn it into the expensive stuff everyone needs.
Precisely. And they're doing this globally. They have the Strathcona Renewable Diesel Project, the Foley Hydrofiner. They're all about changing the mix of what they sell. And this is possible because 85% of their manufacturing capacity is co-located.
Co-located.
It means their refineries and chemical plants are on the same sites. This gives them incredible flexibility.
How so?
Imagine you run a restaurant. If the price of steak suddenly drops, you can instantly decide to turn that beef into high-end burgers or a stew without having to ship it to another building across town.
Right. It's all in one kitchen.
It's all one kitchen. Same for Exxon. If the market for gasoline drops but demand for plastics or lubricants rises, they can shift their feedstock internally to meet that demand. It's a massive advantage that standalone refineries just don't have.
It sounds like they can pivot much faster than the competition.
Much faster. Their CEO, Darren Woods, has said this product solutions business, the chemicals, the lubricants, is going to drive meaningful earnings growth through 2030. It's not just about the price of crude anymore.
That's a really important point. I think a lot of people just look at the price of Brent or WTI and assume that's the only thing moving the stock.
More complex now.
But it sounds like they're building a business that works even if oil isn't at $100 a barrel.
That's the goal. Resilience. But speaking of the future, we have to address the elephant in the room, the energy transition.
Right. How does an oil giant survive in a world moving toward EVs and lower carbon? You hear Exxon and you think gasoline. If everyone is driving EVs in 20 years, what happens?
This brings us to their future-proofing strategy. And this might surprise you. They are deeply involved in the EV supply chain.
Wait, Exxon is in the EV supply chain? That sounds counterintuitive.
It does, but it makes perfect sense when you think about it. They have something called the Carbon Materials Venture. They're working on developing advanced graphite for EV batteries.
Graphite, okay. Is this just a PR stunt to look green, or is there something to it?
It doesn't look like it. The data suggests real utility. This material could potentially offer a 30% improvement in battery range.
The 30% range boost. That's massive. That's the difference between a car that can easily make a road trip and one that gives you range anxiety.
It is. And it positions them not as a victim of the EV transition, but as a crucial supplier to it. They're also heavily investing in carbon capture and fuel switching to reduce their own emissions.
So they aren't ignoring the future. They're trying to engineer their place in it.
That's a great way to put it. They manage carbon and hydrogen molecules. Sometimes that's gasoline, sometimes it's plastic, and maybe soon it's battery graphite.
So we have the fundamentals, the growth, the future-proofing. But what about right now? For the listener who is looking at their portfolio today or thinking about buying in at these highs, what are the catalysts for the next few months?
We have a pretty busy calendar. First up, Q1 2026 earnings are coming in late April. The consensus is watching closely to see the full impact of those startups in Guyana and Brazil.
We want to see those barrels hitting the bottom line.
We want to see the margin expansion,
Yeah.
exactly. But the big immediate catalyst is Golden Pass LNG.
Golden Pass, the liquefied natural gas project.
Yes. Train 1, which is industry speak for the first production unit, is expected to deliver its first cargoes in this first quarter of 2026. So basically now.
Why is that such a big deal?
Because LNG is a critical part of the global energy mix. Europe, Asia, they're desperate for reliable energy security. Getting this online connects cheap U.S. gas to expensive global markets. It's a huge arbitrage opportunity.
So we have earnings and a massive new project coming online now. Plus, we still have that macro tailwind we started with.
Right. The rotation into energy stocks is the wind in their sails. But of course, no investment is without risk. We have to look at the bear case.
Lay it on us. What could go wrong?
Regulatory headwinds are always the biggest concern. Specifically, right now, the EU methane rules.
I've seen headlines about this. What's the concern there?
The European Union is getting very strict on the methane emissions associated with the energy they import. The worry is that these new rules could impose significant compliance costs or even create hurdles for exporting U.S. products to Europe.
So that could cut off a major market. That sounds serious.
It is serious. However, and this is where the moat comes back in, you have to look at who is best positioned to handle it. Exxon Mobil. Their massive scale, their efficiency, they have the capital to install the sensors, the tech to stop the leaks.
So ironically, strict regulation might hurt their smaller competitors more.
That's the theory. Stricter regulations often hurt the smaller players who can't afford the compliance costs. Exxon might actually gain market share. They might even help shape the policy.
Interesting. So the regulation becomes a barrier to entry. What about oil prices crashing? The nightmare scenario.
It's always there. Volatility is inherent to the sector. But if you look at the sentiment scores, they're neutral. The market isn't panic selling. And remember those cost savings.
The $15 billion.
Right. Because of that, Exxon is profitable at much lower oil prices than they were 5 years ago. They have lowered their break-even significantly.
So even if oil softens to, say, 50 or 60 bucks, they are still printing cash.
They might not be doing record buybacks at that level, but the dividend is safe and the business is healthy. They're built for resilience now.
All right, we've covered a lot of ground. Record production, massive shareholder returns, a pivot to high-margin products, a surprising play in EVs. It's time for the verdict. What's the score?
I'm giving this a bullish score of 9 out of 10.
9 out of 10. That is a high confidence score.
It is. And here's the thesis in a nutshell. You have a company with low-cost assets in the Permian and Guyana delivering 13% growth through 2030.
And a management team that's laser-focused on returning cash to shareholders. That $37 billion is hard to ignore.
It really is. And you have a stock that is acting as a yield compounder. In a market where cash is king, this is exactly the kind of asset investors are looking for. It's not just a trade, it's a multi-year hold.
So this isn't something you trade for a week. This is something you tuck away.
I see it as a foundational holding. Some analysts are even predicting they could hit a $1 trillion market cap by 2030. That's a long runway.
$1 trillion. That would put them in very exclusive company. Apple, Microsoft, and Exxon.
It would. And given the trajectory and the world's continued need for energy in all its forms, it's not out of the question.
So what does this all mean for you listening? It means ExxonMobil isn't your grandfather's oil company anymore. It's leaner, it's faster, and it's surprisingly high-tech.
And it's incredibly generous with its cash.
Before we wrap up, I want to leave you with one final thought to chew on. We talked about that $37 billion in distributions. It's a staggering amount of money. But you have to ask yourself, is this the new normal? Or are we witnessing the last golden age of traditional energy cash flows before the transition fully takes over?
That is the trillion-dollar question.
It sure is. Thanks for tuning in to Smart Wealth with Joshua. We'll be back tomorrow with another analysis.
See you then.